Coming up on Market to Market, Mexico gets a handshake deal as trade talks with Canada come into view. New tariffs are in effect as grain farmers see help on the horizon. Processors bump up shackle space to handle more hogs. And market analysis with John Roach next.
Realize that the economic growth is occurring.
Pioneer Hybrid International is a proud sponsor of Market to Market. Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, August 24 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Delaney Howell. The economy continues its upward swing. However, purchases of big-ticket items like cars and houses declined last month. Sales of existing homes fell 0.7%. Even with good inventory, buyers are suffering from sticker shock. New home sales slumped 1.7%, a 9-month low, with higher mortgage rates cooling sales. Orders for durable goods dropped 1.7% last month. Those transactions rose 1.4% without the drag from declining aircraft sales. And Federal Reserve Chair Jerome Powell signaled an interest rate hike if the economy remains strong. On Thursday, $16 billion in U.S. tariffs and Chinese counter tariffs went into effect. The move took place as negotiators wrapped up 2 days of talks without any progress. The work coincided with continued dialogue between the U.S. and Mexico. John Torpy has more.
A new deal on NAFTA might see the light of day by next week, according to trade representatives from Mexico and the U.S. In the past few weeks, trade officials from 2 of the 3 NAFTA partners have been meeting frequently to craft a trade deal mutually beneficial to each country. The no-huddle offense style of negotiations aims to put a mark in the win column for both the outgoing president of Mexico and President Trump as he campaigns for Republican candidates before the upcoming midterm elections. A tentative agreement between the United States and Mexico would open the door for Canada to rejoin the talks, but several sticking points, including access to dairy markets, could make talks between the 3 North American countries difficult. President Trump has previously threatened 25% automotive tariffs for Canada if they do not return to the negotiating table. President Trump also took aim at tariff target China this week, meeting with lawmakers about passage of new legislation designed to protect intellectual and property rights of U.S. companies. Trump has often accused China of stealing American business secrets for their own gain.
You've all been reading that intellectual property and all sorts of different things of that nature are being stolen from us by other countries.
Earlier this year, China responded to Trump's accusation by unleashing tariffs on U.S. agricultural goods, sending commodity prices sharply lower. To help offset market hardships for farmers, the USDA introduced a $12 billion aid package, built to help farmers regain operating funds. Details of the plan, slated to be released next week, are few and far between, but Secretary of Agriculture Sonny Perdue acknowledged dairy, pork, and soybeans are the commodities most dramatically affected by the tariffs. For Market to Market, I'm John Torpy.
In 1998, the hog industry saw supply and demand meet in a head-on collision that resulted in catastrophic price collapse. Today, USDA numbers show the herd is nearly 20% larger. To date, demand is on the rise while prices remain under extreme pressure. Processing plant operators have been observing the market for a long time and are setting their sights on expansion. Colleen Bradford-Krantz has our cover story. 'Cause 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 'cause
By early next year, Iowa hog producer Rick Chipman should be able to point his livestock trailer in any direction and within 4 hours reach any of 11 hog packing plants.
We've been blessed with a lot of packing space in this area. Unfortunately, the industry as a whole needs more. We have pushed our packing capacity to its limit the last few years. And so it's a good thing that we see additional packing spaces open up.
Chipman, whose Chipman Farms near Harlan will feed out nearly 60,000 hogs this year, said he's cautiously optimistic about the 5 new or renovated Midwest hog processing facilities that are all scheduled to be open by early 2019.
It shows the vibrance and the growth of the industry. We really like how companies and groups of producers are investing tremendous amounts in new technology and state-of-the-art facilities. We certainly like the competitive spirit that we have between the packers when we go to make contracts.
The 5 hog packing plants will ultimately have a combined slaughter capacity of at least 9.5 million hogs annually. That would represent about 8% of the 118 million hogs slaughtered in the U.S. in 2016. Plant owners are also carefully watching tariff and trade negotiations.
The supply is already set on how many market hogs are grown. The demand is determined by how much people want to eat pork in the U.S. and how successful we are at exporting pork outside the country. That is not going to change as a result of new plants being built or not being built.
Prestige Farms plant near Eagle Grove, Iowa, is expected to begin operations after the new year, ultimately building to 10,000 hogs a day. According to Ron Prestige, the additional plants should create more competition among packers for market hogs, which could make for increased producer profits in the Midwest, as the facilities aim to operate at capacity when possible. If the supply of hogs increases too rapidly, however, prices could dip instead.
We, of course, saw this happen in 1998, is when you run into a situation where you actually exceed shackle capacity, at which point packers really don't have to bid anything for hogs because they've already got all their shackles filled.
The new plants feature more robotics, snap chilling, and low-impact livestock handling, which may offer an operating advantage over older plants, primarily within the Midwest. Increasingly, pork plants are leaning toward vertical integration, with owners or partners supplying a larger percentage of the animals, rather than buying on the open market. The Prestige Farms plant in Iowa plans to harvest some of its own hogs, but will buy nearly half from other producers, including 10% through spot market negotiations. If a second shift is added, those hogs will all be bought from other producers.
The poultry industry has evolved to a point where it's almost entirely vertically integrated. I'm not going to criticize other companies that have moved towards a more integrated model. It's not really the big motivation for us. We've just seen a tremendous amount of consolidation in the packing industry and the pork business, and we kind of felt like for the health of the industry, it'd probably be good if there was a little more competition and some new packers.
In Windham, Minnesota, a group of individuals, including hog producers, spent nearly $70 million remodeling a beef packing plant that had closed less than a year earlier. Now open as Comfrey Farm Prime Pork, the renovated facility brought 500-plus jobs back to the community of 4,500 when it opened in May 2017. Company officials say 80% of the hogs will ultimately come from either plant owners or permanent suppliers. The ultimate goal is for Prime Pork to sell a consistent product.
All the hogs that we get from the 3 producers will be basically fed the same diet and have the same sire as far as the boar. And that is really the key to the customer, is to ensure that when you buy a pork chop today, it's going to taste the same today as it does a month from now.
Employees are already processing 4,200 hogs a day, but the final objective is about 5,000 a day. In Sioux City, where the new Seaboard Triumph Foods plant opened in September 2017, officials said they will be particular when buying 1/3 of their hogs from independent producers. The company, which will start second shift operations in October in order to eventually process 21,000 hogs a day, wants to make sure those additional hogs also meet quality and traceability standards demanded by a global marketplace.
We're also pretty proud of the control and the quality that brings by having literally the ability to bring feed to the hog farm, to the processing center, to the package, and then delivering that to the customer. It generates a very high quality product. Our requirements with our open market hogs are that they're essentially identical in configuration, genetics, nutrition, animal care. All of those requirements are the same as if they were internally sourced.
Chipman understands packers need to meet the demand for consistency, but worries what it would mean for the industry long term if packers continued to raise more or all of their own hogs.
That's been a difficult thing for me to kind of chew through. It would be very damaging to independent producers like myself, particularly if the shackle space was completely tied up. When I've approached packing companies in the past, they have seemed to want to keep a balance between ownership and buying from individuals, and that's a good thing.
For Market to Market, I'm Colleen Bradford Krantz.
Next, the Market to Market report.
The commodity markets saw little, if any, green this week. For the week, September wheat plunged 46 cents, while the nearby corn contract plummeted 16 cents. Pro-farmer crop tour pod counts and unproductive talks with China slashed nearly 40 cents from the September soybean contract. Soybean meal bulls lost traction as the December soybean contract fell $16.10 per ton. December cotton rose 24 cents per hundredweight. Over in the dairy parlor, September Class 3 milk futures gained 36 cents. The livestock sector continued to take it on the chin as the October cattle contract shed $4.18, October feeders lost $5.12, and the October lean hog contract tumbled $6.82, or 11.6%. In the currency markets, the U.S. dollar index fell 92 ticks. Crude oil bumped up $3.51 per barrel. COMEX gold poured on $29.10 per ounce. And the Goldman Sachs Commodity Index skyrocketed more than 12 points to settle at 463.45. Joining us now to offer insight on these and other trends is our senior market analyst, John Roach. John, welcome back.
Thanks, Delaney. Nice to be here.
John, we would be remiss if we failed to recognize the fact that you have the longest tenure of any analyst on this program at 40 years. This, of course, deserves a trip to the video vault.
I can't wait.
Coming up next, the Market to Market report.
Well, we'll find that out this week from John Roach, one of our regular market analysts. Welcome, John.
Hi, Chet. Hi, Chet. Hi, Chet.
John, congratulations on 40 years for the show. That's very exciting.
Thank you, Delaney. It's amazing how fast 40 years can go by.
I can only imagine, John, but we got to get to it. We got to talk commodity markets here. Let's start in the wheat market. We've had a tightening global supply. Why are we still showing signs of weakness in the wheat markets?
The wheat market had a big run-up because of the weather problems we're having in this country and problems around the world in a lot of growing areas. We had a lot of areas, yields were all notching lower. And so the market had a great big run-up and ran up into the early part of August. We had what we call a 4-box sell signal. Our 4 key market indicators were all checked. We had everything telling us to make sales at those high prices. And what happened was the funds were major longs, and they took the market all the way up, and now they're in the process, since it's trending lower, of taking it back down. And so we're stuck here with commodity funds that were almost record long, having to get out of those longs now, and it's not going to be over within a day or two. This is going to take a little bit.
So with that being said, John, are we going to remain at these current levels, or are we going to test lower?
Well, it's going to really depend on what the users want to do. We don't see very many farmers that want to sell anything here, so it's just a matter of the specs selling, and they're selling to the users. And so to the degree the users need to come to America to get wheat, then we get that business. But we've got a new situation going on with Russia, where they're talking about maybe having to put some sort of a restriction on the amount of exports, 30, maybe 31 million tons, instead of when they were expecting 35 million tons. Now, the jury's still out on that, but the smart people are saying they're going to run out.
And what are you saying, John?
They're going to run out.
Okay.
The Russians are going to run out, and so you hold wheat now at these cheap prices into higher prices, and we normally peak wheat in February. So put your wheat in storage, get ready to go through this whole process and look for better prices as we get into the winter.
What if folks don't have on-the-farm storage? Should they be looking if an elevator or a co-op has storage availabilities? Would you still suggest they hold the wheat until February timeframe?
Well, the problem is that they made a bad mistake in August when they had very good reasons to be making sales and didn't do it. And so they knew they didn't have storage in August or in July. And so now we're, as you say, 40-some cents cheaper this week. It's awful hard to go out and make sales at this kind of a cheaper price, but I hate to pay commercial storage. So as long as I can hold my storage bill reasonable, then I'd still go ahead and pay the storage. If not, I'd sell the wheat, come back and buy it on the board later.
Okay. John, let's take a commodity question. We had the Pro Farmer Crop Tour this week. We've got a great question that came in about that. Michael in Spencer, Iowa would like to know, will the Pro Farmer Crop Tour yield estimates carry more weight in the market going forward than the USDA estimates?
No. The USDA estimates are taken with a lot more data points, lots more data points. What we look for in the Pro Farmer numbers is to see whether they verify what the USDA has forecast. And they actually pulled the number down a little bit on corn, and they raised the number on soybeans. And so at the moment, most people are going to look at the crop situation and say, well, the USDA is probably about right. It's going to depend on what the weather does from now until harvest, and the possibilities are that we could pull the yield down a little bit on corn, but I wouldn't bet on that. And the possibilities are that we'll have bigger beans, and I would bet on that. So I think that we have big crops out there, and now we have to figure out, okay, how are we going to hang on to them to get through this harvest glut and get out into the spring of the year?
Okay. One of the other big observations that was made this week was just the advancement of the crop. We have a really fast maturing crop going on here. Some people were speculating that in as little as 10 days to 2 weeks, we could be seeing some harvest. Is that what you're also seeing, John? We're
actually hearing about some harvesting starting already. So yeah, no doubt about it. As we move into September, we're going to start up more and more combines. And as a consequence, we're going to have a lot of inventory that's going to have to find a home and a space. And so we could see some pretty discounted bids out there. So if you've got to make sales, I'd rather make sales now rather than in the gut slot of harvest. But I really don't want to sell anything. We're buying corn. We have buy signals on corn. We have buy signals on wheat. We have buy signals on meal. So for livestock feeders, this is your time to come to the marketplace. It's time to accumulate and take advantage of these lower price levels. We will have a better story to tell 3 or 4 months from now than we have today, I believe.
Okay. John, the other thing I wanted to make sure we touched on here quickly before we move on to soybeans is harvest lows. Usually we put in a low around harvest season. With the potential of harvesting so much earlier this year, are we going to test new harvest lows, or do you believe those have already been priced into the market?
I think we can probably still test the lows we made, and we perhaps can even take them out. Remember, in the last 2 years, the corn actually made its contract low, its bottom, on the last day of September, or last day of August, as delayed pricing contracts were flushed through the system. We were at the Farm Progress shows in each of the last 2 years, and we were there, and the people walking around had the longest faces in the world. It was the low of the corn market. It could be that same way again next week when we're at the Farm Progress show. We hope not, but that well could be the bottom, but that's the key. We're within weeks, I think, of a bottom of this market, maybe days, and so you have to be thinking as a livestock producer, you've got to get some feed needs accumulated, and as a grain producers, this is not a time to be making sales. We don't plan to make sales at the end of August ever, and we don't plan to make them this year.
Let's talk about soybean harvest off of crop sales here. Usually folks take soybeans, sell them right off the combine, and store corn Do you see that transitioning to the other way this year because of the trade disputes?
That's a real good question. We're going to have to see the program that the government's coming out with on Monday, where they're going to show us how they're going to pay farmers in order to cover for some of the tariff issues, and see how they do it and what the mechanics are. I don't know what those are at the moment, so I'm going to be learning along with growers on Monday. But it would seem to me that it might actually give farmers reason to hold on, because they would like to take the government's money and hold on to the beans too, and try to double dip a little bit. So I just think that's going to be the attitude. Farmers are going to try to put away everything they can put away this year, I believe, and I think that'll give us a good rally into the winter months.
John, besides crop tour, we've got trade and tariff news. The other big news right now, kind of shocking the soybean markets, is the African swine fever. From your perspective, how is that going to affect soybean demands moving forward?
Well, you're exactly right. In the last week, I have 4 cases now of African swine flu that's been confirmed, and the distance between the north and south one's 2,300 kilometers. So it's not all concentrated in one area. It's spread out across the country. The outlook is not really good, or the prognosis, because it's going to take a lot of work in order to take care of that problem, and we don't know how deep that goes and how much culling there will need to be done. But 17% of the world's hogs are produced in China. And so whatever happens to their hog industry impacts the red meat industry really all around the world. And so the initial impact is we've got surpluses of pork that we're not able to sell it because of we're not selling what we should because of the export tariffs. And so we're stockpiling up a little bit. And so we've got to move that through the system. And some optimism can come back as we get into the new year, when we start looking at maybe somebody's going to have to supply pork to China if this African swine flu continues the way it appears. Somebody's going to have to supply pork. And so we look for a pretty optimistic year in 19 based on everything we know today.
Okay, John, let's talk.
And that's a turnaround, by the way.
Okay.
That's a turnaround from what we were expecting.
It is absolutely a turnaround. John, let's talk live cattle. Why can't we get away from this 108 to 112 roughly cash price level?
We're moving cattle through the system. We're at peak slaughter numbers right now, and the cattle on feed report showed the cattle on feed at a record level. So it's supply driven. We've got a lot of supply out there. The good news is that the packer is able to move the beef at some higher prices. The packer's making a lot of money. They'll probably have a record year, and some of that will trickle back down to the livestock producers. We think prices can do better, and so we think that we're in a kind of a low ebb area here. We think with what's going on in China with their pork industry means that you have to be more cautious about selling anything out ahead, and become a little more optimistic about overall demand here in 2019 and beyond.
John, you said you wouldn't sell out very far ahead, so how far out would you look?
I'm worried about what kind of hog prices we could have between now and October. And in the same way with the cattle, I mean, I think we could, but I think cattle market's higher. I mean, I'm not sure I really want to hedge anything here. I think that we have better prices out ahead, and so how long does this all run? That's a really good question. But I would think that the cattle business could be, we could have a strong market into October.
Okay. John, I want to make sure we get some time here for the lean hog market. 11.5% drop this week. That was huge. And we have a great question that came in on social media. I want to take here right off the top. We've got Ben in Rochester, Minnesota, would like to know, is there any end in sight for the decline in the cash hog prices? An estimate of percentage of national herd is packer owned or controlled. Do you know that percentage? I think is the question there.
I don't know the percentage that how that actually divides out. But the situation we're in right now is we're having to deal with the culling of the herd in China, and we don't know how deep that's going to go, how long that's going to last, and how much that's going to impact the overall meat situation. So we're just a few days into this African swine flu. And I don't want to really blow it clear up out of proportion, because it might just fizzle out. But again, our worry is that there's going to still be liquidation, that they've already had liquidation occur. They've already dropped the prices of breeding stock sharply. And so we have to work our way through that problem.
long term, will this problem provide some stability for the hog market, especially in the U.S.?
I'm not sure stability is the right word, but I think it'll provide strong demand. I think that they'll come to us. They'll have to source pork from around the world.
Even with the tariffs in place?
Even with the tariffs in place. The worst thing in China is not having enough food and having people worried about food supply. So they'll buy the pork that they need to buy.
John, really quick here, we had a cold storage report come out today, up 119% from last year. Can we chew through that pork if we don't get the demand from China?
Well, that's the reason we were all worried about the pork market for next year and the cattle market for next year. And the China thing has been a bright light that's come on. It's a new light, and we just don't know how bright it's going to get and how long it's going to last. But enough so that you take away the negativism for 2019.
Okay, John Roach, thank you so much.
Thank you very much, Delaney.
That wraps up the broadcast portion of Market to Market, but we will keep the conversation going on Market Plus, where we'll answer more of your questions. You can find it on our website at iptv.org/MTOM. Join us again next week when we pull artifacts out of the nation's attic for a look at 100 years of the tractor. So until then, thanks for watching. I'm Delaney Howell. Have a great week. All right, now we're on.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Pioneer Hybrid International is a proud sponsor of Market to Market. Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.